Okay, guys, welcome back. Okay, guys, let's continue where we left. Any questions before we continue further? And may I request all of you to please switch on your cameras. Okay, great. So in this case, I'll just repeat that if the market rate is equal to coupon rate, means as a new investor, as a current investor, I'm getting what I should get. As a result, I'm ready to pay a market value, which is equal to the face value, and the bond is trading at a par. But if for some reason the market rate is higher than the coupon rate, it means the risk associated with the bond has increased. So if you are a new investor, the market value you are ready to pay will be less than the face value to compensate for that lower return what the company will be paying you. And as a result, we say that the bond is trading at a discount. If for some reason the market rate is lower than coupon rate, means the company is paying you more than what should get paid. But the existing investor will sell it to you at a premium, because why the existing investor will give you a bonus. So let's say when the existing investor bought it for 10% and the market it has gone down to 8%, the benefit will not be passed on to you. The existing investor will take the benefit and will give you the bond at a premium. So as a new investor on day zero, you'll neither benefit nor lose based on what has already happened in the market rate. If the market rate has already gone up, you'll buy it at a discount. And if the market rate has already gone down, it means the company has become less risky. Though you want to buy it at a par, but nobody will give it to you at a par, and you'll end up paying a premium for these bonds. Okay? Now the next question is, how do we know whether it'll be 1100, 1110, or 1090? All I know is this bond will be trading at a premium, but how much premium is the question. So in this case, we should know the time value of money. Time value of money means if I tell you that I've got 100 rupees today, what is the value of this after 1 year? How do you calculate that number? Let's say the interest rate in the market is 10%. If you got 100 rupees today, how much will you have after 1 year? Especially the people who have not done time value of money as a concept. I want to listen it from them. Samay, you say that I'm not audible. Are you guys not able to hear me? Guys, are you able to hear me or not?
Yes,
We
sir.
can hear
Yes,
you.
we can hear.
Samay, can you just check your speaker once if there's any problem with that?
But we are not able to see your screen.
Oh, you're not able to see the screen. Yeah, that's fair. Thank you.
Yes,
Now
sir,
you
I can
must be able.
hear you now. I rejoined.
Okay, cool. So let's say if you got 100 rupees today, what will be the value of this 100 rupees after 1 year? If the rate of interest in the economy is 10%, how much will you have after 1 year? Anushka,
110.
110? Because simply you'll get interest for 1 year. Let me make it a bit more difficult. What will be the value after 2 years?
121.
121 is the answer. Why? Because in the second year, you won't get interest on 100. You'll get interest on 110. And this is what we call as compounding, that you start generating interest on the interest already earned. So in 1 year, if you're getting 10% return, in 2 years, you won't get 20%. You'll get more than 20% because whatever interest you generated in the first year, that money will be further reinvested for the second year. Is that clear? Going by that logic, what we have to, so this is what we call as compounding. If I know the value today, what will be the value after 2 years is what we call as compounding. What is discounting? I know the value after 2 years. What is the value today is discounting. So compounding is very easy. We have done it in the past. You have done it in your college and schools. So the formula, if I want to give you, if the present value is 100, the compounding would mean that whatever is the interest rate, you make a power of 2 and you'll get the future value. So from present value to future value, from today, you're going to after 2 years, this is what we call as compounding. The reason we call it compounding is because this 121 will always be more than 100. It means if the value of something is worth 100 rupees today, the value will be worth more than 100 rupees 1 year, 2 year, 3 year, 5 year, 10 years down the line. But if I want to reverse the equation, let's say if I know the face value, sorry, I know the future value. The future value is 121. If somebody asks me what is the present value for it, what is the value today? So to calculate the value today, I'm going to use the same formula that the present value is nothing but present value into 1 plus 10% to the power of 2 is face value, future value. So the present value will be equal to future value divided by 1 plus 10% to the power of 2. So if I know future value ka formula, you can calculate the present value ka formula. Is that logical, reasonable? So in this example, the company is paying me 100 rupees after 1 year, 100 rupees after 2 years, 100 rupees after 3 years, 100 rupees after 4 years, 100 rupees after fifth year, along with my 1,000 rupees. Just to keep everything simple, let's assume that my market rate is 10% in this case. If the market rate is 10%, and if I'm getting 100 rupees after 1 year, the value of this 100 rupees today is equal to 100 divided by 1 plus the market rate. The market rate is the discount rate or the interest rate. This 10% is irrelevant. This 10% will decide how much money you are getting. But the interest rate relevant for your calculation is the today's rate in the market, which is 10%. So you will discount it at 10%, which is this. And how many years you'll be discounting it for? You'll be discounting it for 1 year. So I'm saying this 100 rupees is worth 90 rupees 91 paisa today. This 100 rupees is worth 82 rupees 64 paisa today. And this seems logical that this 100 rupees is worth more than this 100 rupees. Because this 100 is worth only 90 rupees, but this 100 is worth 82 rupees. This 100 is worth even lesser. This 100 is worth even less. And this 1100 is worth 683 rupees. So if I'm a new investor in this bond and I should get a return of 10%, and I know that this is what the company is going to pay me, I do my calculation and I would think that the total value I'm going to get from these investments is equal to some of these numbers. And if I add up all these numbers, not a surprise at all, is equal to 1000 rupees, which makes sense because company is giving you 10%, you're discounting it at 10%, the market value is equal to the face value. That's what we said, but we did it more logically. Now we are doing it mathematically. Reminder for everyone to please switch on your cameras. Guys, can I do one quick thing? Like I just downloaded the app for Zoho. Rather than doing it on the web, I thought I'll do it from the actual application being downloaded. So can I just like end the session and just like get in again, like in 2 minutes? I think I'll get more flexibility in terms of, the tools and options I get.
Yeah, but I
I'm
think
finding it.
for joining the meeting, it is asking for the meeting link or meeting ID, which I was not able to track. Can you just help us with that meeting ID or meeting link in the chat window?
Oh, okay. Let me just log in from there and let's see if I can join and then I can help you as well. Okay.
Am I audible? Uh, I think you're not audible, Ansh. There's
Oh,
some issue.
yeah, I was on mute.
Yeah,
So
I could only see you. Yeah, well,
it's
it's okay.
been 4 years, like in COVID, and still not learned how to unmute myself. Sorry. Uh, okay, guys, not too many extra additional options I got, by the way. Even if I'm dialed through the applications, you're not missing out anything. Okay, cool. So let me share the screen again. Entire screen. Okay, are you able to hear? Are you able to see the screen now?
Yes,
Cool.
yes.
So if my face value is 121, if I want to calculate the present value, I'll do the reverse engineering, that 121 divided by 1 plus 10%, which is the interest rate, to the power of 2. So if my future value is 121, my present value is 100. If my present value is 100, my future value is 121. So going from 100 to 121, this is what we call as compounding. Come from 121 to 100, this is what we call as discounting. So in this case, I cannot add all these numbers together because they're coming at different point of time. So what I'm doing is I'm discounting this 100 rupees for 1 year. So I get the value today. I'm discounting this 100 rupees for 2 years. So I get the value today. I'm discounting this 100 rupees for 3 years. I get the value today. I get the value today. I get the value today. And if I'm a new investor and my risk perception associated with the company is 10%, I believe that in today's terms, I'm going to get this much money. So how much I'm ready to pay? I'm ready to pay this much money. I would love to get it at less than 1,000 rupees so that I can make some profit. But why will somebody give it to me for less than 1,000? And will I pay more than 1,000? No, I won't pay more than 1,000. Now, because this 1,000 and 10% doesn't change, but this 10% keeps changing, this entire thing becomes very interesting, guys. Why it becomes interesting? Let's say you think that the company is going to do really good. So you invest in the company when the company is more risky, when the company is smaller in size, when the industry is in trouble. As a result, at that point of time, given the market rate was 10%, you'll get a coupon rate of 10%. But think about, as per your expectation, the company starts doing better, the company becomes bigger, the market rate will go down. And the market rate can go down to, let's say, 8%. If the market rate goes down to 8%, though you are getting a 10% return, which is the coupon rate, the discount rate or the market rate is 8%, means you're getting 2% more every year. And as a result, the value of the bond goes up. See the market value, it goes up to 79.85. The question you must be asking me is that if the market rate is 8%, the coupon rate is 10%, the gap is 2%, which is equal to 20 rupees every year for the next 5 years. So if you're going to get 20 rupees every year for the next 5 years, you're going to get 100 rupees extra. So the premium of the bond should not be 79.85. The premium of the bond should be 100 rupees. But guys, in this case, the premium is not 100, the premium is 79.85. The reason being, you're going to get 20 rupees extra every year for the next 5 years. Total, you'll get 100 rupees more. Present value of these 20 rupees is 79.85. As a result, when the market rate comes down to 8%, the value of the bond doesn't go to 1100. The value of the bond goes to 1080. Because you're going to get benefit by 20 rupees for the next 5 years, and the present value of that 20 rupees for the next 5 years is 79 rupees 85 paisa. And for some reason, if the company becomes more risky, the market rate goes up to 12%, the value of the bond will go down to 927.9. What is the discount now? Rather than 1000, the value is 927.9. The value is 72 rupees lower. Why the value is 72 rupees lower? Because you're losing out 20 rupees every year. Now these 20 rupees are being discounted at 12%. So the present value is equal to 72 rupees 10 paisa. So when the market rate is lower or the market rate is higher, the differential is 20 rupees in both the cases. But when the market rate is lower, you're discounting that 20 rupees at a lower rate of interest. When the market rate is higher, you're discounting it at a higher rate of interest. So guys, the market value will not go up by 100 or come down by 100. The difference will be less than 100.
So the difference will be less than 100 in both the cases, premium as
Yes,
well as discount.
exactly.
Okay.
But in case of discount, it will be even it'll be the difference will be less than 79 rupees. The reason being the discount rate is higher.
So the difference in premium will be lesser and discount
Okay,
will
so
be
let
more.
me do it. If it's 10%, it's 1000 rupees. If it goes to 12%, if it goes to 8%, the value goes up by 79 rupees. But if the market rate goes up to 12%, the decrease will not be 79 rupees. The decrease will be only 72 rupees. So the decrease is lesser, increase is more.
Okay.
And why the decrease is less? Because the interest rate is 12%. So those 20 rupees every year are being discounted at 12%. Why the increase is more? Because that 20 rupees will be discounted at a lower rate of interest. So guys, for the investors, it's a good thing that the decrease is less, the increases are more. Great. So let's go through some of the theory part. The principal, par, or face value all are same thing. If the bond is trading at par, the bond will be trading at 1000 rupees, which is nothing but the face value, which is also called as the principal of the bond. So all of these three things means one and the same thing. Now I think that have a very good idea what the coupon rate is. You have a very good idea who the issuer is. The company who's borrowing the money is the issuer. The maturity of the bond is nothing but 5 years, which is nothing but the tenure of the market. If it's a short-term bond, like less than 1 year, we say it's a money market security. But if it's a long-term, more than 1 year, we call it capital market. I'll repeat. If it's less than 1 year, we call it money market, as in short-term. If it's more than 1 year, we call it capital market, which is nothing but long-term. But there are some bonds which are till eternity. It means I'll borrow the money from you. I'll keep giving you interest year after year after year. When do I pay you the principal back? Never. Now, obviously, perpetual bonds is not for individual because at some point of time I'll die. These are mainly for the institutes or like the organizations. They say we'll keep giving you interest for your lifetime. the principal or the par value or the face value which is written on the face of the bond, which will never ever change. The coupon rate is nothing but the interest rate you're going to get on the bond, that will never ever change. The how frequently you'll get the coupon rate is the frequency of it. If you're getting the 10% on an annual basis versus you're getting a 10% on a half yearly basis, 10% on a half yearly basis is much more much more better compared to getting 10% on a yearly basis. If you get 10% on a quarterly basis, even better. If you get 10% on a monthly basis, that's even better. Your overall return will be 10%, but it's just that you'll get it before rather than after. Now, before we get into other things, there are some notes or there are some bonds which are floating rate. What do we mean by floating rate? Let's say the company issued the bond at 10% and the market rate is also 10%. Now, in this case, the company can say that if something happens in the economy, if something happens in the company, and if the market rate goes to 11%, I'll pay you more, which is 11%. If the market rate goes down, I'll pay you less, which is 9%. These kind of bonds are called floating rate notes. It means the interest rate or the coupon rate will change in line with the market. And these are the most boring notes. Because you are getting what the market should get. Are you being paid for the risk you took? No. So for all the practical purpose, for all the discussion we are going to have in fixed income classes, we'll assume that the coupon rate is fixed. It doesn't change. Because if the coupon rate starts changing along with the market rate, it becomes a very, very boring bond. Because then you do not benefit with the change in the market rate. You do not lose with the change in market rate. Make sense? But you should know that these kind of bonds exist in the market. Now there are some bonds which are zero coupon bond. What is the zero coupon bond? This interest rate is zero. So guys, I'm telling you that I'm giving you a piece of paper where I'm saying that I'm going to give you 1,000 rupees after 5 years. Let's say you think that the risk associated with me, first of all, you'll say that I don't want to give you the money, we don't trust you. That's fine. But you can say that, Acha, we can trust you if you give us 10% return. So if I'm going to give you 10% return on a half yearly basis, you are ready to pay 1,000 rupees for this piece of paper. If I say, no, I'm not going to pay you 10%, I'm going to pay you 8%. You'll be like, dude, given your background, the risk associated with giving you the money is a lot higher, but you're giving us only 8%. So we want to buy this at a discount so that we can get compensated in the form of capital gain. So you'll buy this particular bond at 900 rupees. What if I say that I'll give you only 5%? You'll say, dude, 5% is too less. Then I'll pay you only 800 rupees for this bond. And what if I say that I'll pay you nothing? It's a zero coupon bond. I won't pay you anything for the next 5 years. Then you'll say, okay, then I'll pay only 650 rupees for it. Because today you'll pay 650 rupees. For the next 5 years, I won't pay you anything. After 5 years, I'll pay you 1,000 rupees. Technically, that 350 rupees is nothing but the return on your investment. So these are called zero coupon bond. And if you want to price a zero coupon bond, this 10% will be equal to 0. Market rate is 10%. These bonds will be trading at 620 rupees 92 paisa, because you're not going to get anything except 1,000 rupees at the time of maturity. And the present value of that 1,000 rupees at today's market rate is 620 rupees 92 paisa. So you'll be ready to pay 620.92 rupees for these kind of bonds. This is a discount of how much? 379 rupees. And this makes sense to me because if you take 100, you're losing out 100 rupees every year. And the present value of 100 rupees every year is 379 rupees. The total is 500, but the present value is 379 rupees. So in case of a zero coupon bond, the bond will be trading at 620 rupees 92 paisa. And these bonds are not just trading at a discount, they're trading at a deep discount, or we call them pure discount bonds. Which companies will issue these bonds? Mainly the companies in startups. They can give you a huge amount of interest rate, but they don't have money to pay you. They can pay you the money after 3 years, 4 years, 5 years, once they have grown bigger. But today they don't want to take out any money from the company because this will compensate or this will compromise the company's growth perspectives. I told you that these bonds can be senior bond or junior bonds. What are senior bonds? That if the company goes bankrupt, the senior bonds will be paid first, then the junior bonds. So which are more risky? Junior bonds are more risky. Keeping everything else constant, the market rate will be more for the junior bonds and the market rate will be lower for the senior bonds. And guys, there's something called options, which are put on these bonds. So there is something called a plain vanilla bond. Guys, I love vanilla as a flavor. How many of you like vanilla as a flavor?
Yes, sir.
You like it?
Yeah.
Anyone else other than Rishabh who likes vanilla as a flavor? So according to the financial world, sorry to say, vanilla is not a flavor. So a bond without any flavor, without any topping, without anything interesting is called a plain vanilla bond. I'll repeat, a plain vanilla bond means it does not have any flavor. What could be the flavors? The flavor could be that it's a floating rate note. The flavor could be it's a zero coupon bond. The flavor could be that there are some options available or there's some topping on the bond. So there could be some interesting bonds with some flavor, with some interesting aspect to it. And we are not going to cover it now. We are going to cover it later in fixed income. But for now, we are going to talk about plain vanilla bond. Now see here, for a fixed coupon bond means the coupon rate doesn't change. When prices fall, the bond offers a higher yield. Yield is nothing but the market rate. So if the bond value is less, it means the market rate is more. Because the only reason the market value will fall is because the riskiness associated with the bond has gone up. So higher the market rate, lower the market value. So the minute you hear the word yield is nothing but the market rate. Now there's something called yield curve. What is a yield curve? That for different maturities, you get a different return from the market. Generally for a short-term investment, you get a lower return. For a long-term investment, you get a higher return. Why that is so? Because if you're investing for a longer term, you are taking more risk because your money is being stuck for a longer period of time. Guys, I see just like a couple of you with your cameras on. May I request all of you to please switch on your cameras?
Ansh, I have one small question.
Yeah.
Like you told initially that being like the floating rate bonds doesn't give any benefit, but because
No.
it kind of follows the market rate. But like
Right.
what I have seen, like for most of the debt issuance, they kind of create a mix between a fixed rate and a floating rate. Like
Yeah.
they kind of take the SOFIA as the fixed component and take a variable on that or something.
Yeah, so there could be bonds. Like if I want to make a portfolio, I can make a mix of these bonds. Part of them are fixed, part of them are floating. But my point was that for 99% of the discussion in a fixed income class is assuming that the bonds are fixed coupon bond. Because once you make the coupon rate to be flexible or to be floating, then the things will like this will change as per the change in the market rate. So it becomes very boring. And then as an investor, I cannot invest in a bond or the company expecting that the company will become bigger and better. As a result, the market rate will go down and I'll be able to make a return out of the bond. Because when the market rate goes down, the coupon rate will go down as well. I don't lose money when the company does bad. Because when the company does bad, the market rate goes up, the coupon rate also goes up. So you will see that every time I'm assuming that the coupon rate remains fixed. Okay. Now there's something called bond indenture. Indenture is nothing but an agreement. So bond agreement is an agreement between the company, which is the issuer, and the investor, who is the bond holder. And it's a huge list of agreement. The key component of those agreements are what is the face value, what is the coupon rate, what is the frequency of the payments, what's the maturity of the bond, and so on. Based on that, I'll decide that acha, company is paying me 10% coupon. Can I tell the company to increase the coupon rate? No. Company is saying, okay, this is take it or leave it. Now, if I think that the risk associated with the company is more than 10%, I'll try to buy this at a discount. But if I think that the company is paying 10%, which is very, very high, I'll be ready to pay a premium. So again, coming to the same thing, if coupon rate is more than the market rate, it means the company is paying more than what it should pay. As a result, the bond will be trading at a premium. But if the company offers less than the market rate, it means I'm getting less than what I should get paid. The bond will be trading at a discount. Now, if you are giving the money to the company or to a government, you want the money back, right? Not only the interest, you want the money back as well. So in this case, what are the sources of repayment? Now it depends whether you're investing in the central government bonds, state government bonds, or the municipal bonds. Let's say if you're investing in the national government or the central government bonds, and we call the word sovereign. Jahan pe bhi you see the word sovereign, it means I'm talking about the central government. In case of the bond which are issued by the central government, the money what you paid to the government will give you the money back based on the money they generate as an overall country. So the country is doing good, you'll get your money back. I'll give you an instance. Let's say Indian government took money from you and they use that money from the bond in giving employment to a particular class of people. Or they give that money, they spend that money in the water availability in some poor outskirt village areas. अब रिटर्न कहां से आएगा तुम्हारा उसके ऊपर? Is the government going to get paid for that? No. You don't have to worry about where your money is being used. As far as Indian government has money, they'll pay you the money. That money can come from the GST they collect, that can come from the income tax they collect, that can come from the other sources of money they have. And from those sources, they'll give you the money back. So if you're giving the money to the central government, is irrelevant for you where your money is being invested. What is relevant for you is whether you think that the government is strong enough, is wealthy enough to give your money back. Okay. So the sovereign or the national government bonds are repaid from taxes on the economic activity, and in some cases, the ability of a government to create new currency. They can print more currency and give it to you, right? But if you're giving the money to a local government or the municipal government, there are different types of bonds within municipal government. These bonds could be the local government taxes. It means the municipal bond, let's say in case of Bangalore, we have got BBMP, Bangalore Municipal Palika. Now, what they say is that, okay, this is a bond A. If you take bond A, we will repay the money from the taxes we collect from the people. These taxes could be property tax. These taxes could be any other municipal taxes. So these kind of bonds you'll invest when you think that the municipal corporation will have enough tax income going forward. But within municipal bonds, there's another category. Let's call it category B. In this case, I'm saying, hey, I'm planning to make a flyover from point Y to point Z. And to make this flyover, this is going to cost me 1,500 crore rupees. So I'm taking money from you guys. I'll take this money and invest into the project. And once the project is ready, I'm going to collect the toll from the people, like 30 rupees every time some people use the flyover or the bridge. And whatever money I get from the toll collection, I'll repay the money to you. So these kind of bonds are called the revenue bonds or the revenue from operational infrastructure, such as toll roads. If this is the scenario, your focus is not about how good or how wealthy the municipal corporation is. The focus shifts to the project, whether you think that the project is profitable or not. Because even if the municipal corporation has got lots of money, they won't pay you the money, except that if you're getting the money from that particular project. So to understand whether these bonds are issued by the municipal corporation and the money will be repaid from the local government taxes, then the focus is on the overall wealth of the municipal corporation. Otherwise, your focus is on that particular project for which the money has been borrowed. Similar to Mr. Ambani, right? Mr. Ambani can say, hey, I need money on personal grounds. Then you will focus on Ambani's wealth. But if Ambani says that, okay, I need money for Reliance Jio, then the focus is about whether Reliance Jio as a company will be able to make profit or not. The bonds can be secured or unsecured. Secured bonds means, let's say if I go and take a loan from a bank, I give my house as a mortgage. Is a secured loan. Because if I do not repay the loan, the bank can take my house over and sell it in the market and get money out of it. So in case of company bonds as well, they're secured bond. What is happening in a secured bond? The company is saying that, okay, I'm issuing bonds worth 1,000 crore rupees. And against these bonds, this particular plant or this particular machinery worth 1,000 crore rupees is I'm putting as a mortgage. So if I'm not able to pay the money to these bond holders, this particular machinery can be sold in the market to repay the money to these bond holders. If it's a secured bond, it's a safer bond, the market rate will be lower. But if it's an unsecured bond, the market rate will be higher. There could be bond covenants is a part of the agreement where the issuer or the borrower of the company will make some commitments. They'll make commitment to who? They'll make commitment to the investor. What commitments? They'll make two types of commitments. Affirmative commitments, which are what we call as affirmative covenants, where the borrower or the company is promising to do few things for the investor. And the negative covenants, which the borrower or the company says we will never do. or we'll make sure that we don't do it. But whether it's an affirmative covenant or negative covenant, both are good for the investor. I'll give you an example. Affirmative covenant, I would say, hey, I'll pay your money on time. Hey, I'll make sure that uh, sorry, give me 1 second. I pay your money on time. I'll pay your principal on time. I will pay your interest on time. These are affirmative covenants. I'm promising to do few things. But negative covenants means that I want to do something. It means I want to default on you. I won't take any other loan without your permission. I will not sell the machinery which I put on a mortgage. So I'm promising to do something. I'm promising not to do something. I'm promising to help you and to give you money on time. And I'm promising not to hurt you and not to default on you. So both these affirmative covenants and the negative covenants are for the safety of investors. Because if these covenants are not followed, the company can be dragged to the court and like the company could be fined.
So could you explain secured and unsecured again?
In case of a secured bond, the company is saying that, okay, I'm borrowing money from you, but I'll try to pay the money from the money I generate from the business. But for some reason, if I'm not able to pay the money back, this particular plant or machinery, this whatever money I'll get from selling this plant or machinery in the case of bankruptcy will first go to you guys as a bondholder before I can do anything else with this plant or machinery. Okay, so that was the first topic, guys. It's a bit of theory and practical stuff, but now we'll get into the second topic, which is fixed income cash flows and types. I'm sorry, guys, but can I just take an early break? I have to just step out for 5 minutes. So I know like we just started 50 minutes back, but slightly early break. It's 11:46. We'll be back at 12, and then we'll have another session for like around 100 minutes, if that's fine with you. Okay. So see you at 12, guys. Okay, guys, welcome back. Know, guys, when you're back. And please switch on the camera so that I know you are back. I request all of you to please switch on your cameras. I don't see all of you with your cameras on. Rakesh, Vivarsha, Ria.
So sorry, but I'm still facing issue with this Zoho switching off the
Okay.
camera. So
Well,
sorry.
you're not the only one. That's okay.
Sir, I'm sorry, but I'm also facing the same issues. I have
Can you
just
guys?
logged in multiple times, but then also I'm facing the same issue.
Yeah,
Okay.
same here. I tried logging in multiple times. Also tried the app, but then didn't get the link.
Okay. Okay. Keep trying, guys. At some point of time, it should work. Okay. So let's go to the next topic. We are going to talk about the types of fixed income securities and the cash flows. We have covered a part of it already. Now, a typical bond has bullet structure. What do we mean by bullet structure? In this example, the company borrowed 1,000 rupees from you. Though the company is paying you the interest on an annual basis, but the full repayment of 1,000 rupees principal is in one bullet, in one shot. We call them bullet structure. It means rather than paying the money on a regular basis, the company is paying the full money in a single shot. I'm not talking about the interest, I'm talking about the principal amount. So the typical bond has a bullet structure where principal or the par value is paid back in a single payment at the time of maturity. Periodic payments across the life of the bond are purely interest payments. It's different from EMI. EMI में क्या होता है? You pay some interest, you say pay some principal over a period of time. So that towards the end of the loan, at the time of maturity, you do not have to pay any lump sum money. But in case of bullet structure, all you're paying is the interest part, so that at the time of maturity, you have to make a lump sum payment to the investor. How the typical payments will work? If it's $1,000 bond with a 5-year maturity with a coupon rate of 5%, the company will pay that person 50 rupees every year, and at the end of the 5th year, the company will pay 1,050. So technically, the principal remaining is $1,000 for the next 4 years. So that $50 what the company is paying is only the interest part, and the full principal amount will be paid back in the 5th year. Other type of bonds could be amortizing loan. Amortizing loan में क्या होगा? You don't just pay interest, but you also pay a part of the principal on an annual basis. So you kind of pay an EMI. So in this case, I can think of a number. Let me do it here. So the company might pay rather than 100 rupees every year, the company might pay 220 rupees, not 220, 250 rupees, not 250, 275 rupees, not 275, 265, 264. See, now I can reduce it further, 263. Yeah, 263.5, 263.8. So if
Sir, your
company
Excel is not visible.
it's visible, no? Like I'm sharing, let me reshare. See now, can anybody see my Excel or it's a problem for all of you?
Good
We can.
thing.
Sorry,
Now
can
it's
see.
visible.
now you can see. So what the company can do is, company can say, hey, I'm borrowing 1,000 rupees from you, and in the first year I'll pay you 263 rupees 80 paisa. But out of this 263 rupees 80 paisa, how much is the interest for the first year? The interest for the first year is 10%, which is 100 rupees. It means when the company paid 263 rupees 80 paisa, the remaining amount is nothing but the principal, which is 163.8. What is the remaining principal amount? The remaining principal amount is now 1000 minus 163.8. The second year, when the company again pays 263 rupees 80 paisa, how much is the principal interest amount? Now the interest is lower because the company has paid some money already. The interest amount is 83 rupees 62 paisa. So now the principal component is more. So guys, this is EMI. This is the interest component and this is the principal component. With each passing year, because your principal component keeps going down, when you pay 263 rupees, the interest component will go down. So the principal repayment, what you're paying is more and more. Now in the second year, you repaid how much? 180. So the remaining principal is how much? 836 minus 180. So the EMI you're still paying is 263. Of that 263, the interest you have paid is 10%, and the remaining is principal. Because you paid more principal, the remaining amount is 656 minus 198. The EMI you're paying is 263.8. So the interest part is 10%, and the remaining part is principal. As a result, in the last year, the balance amount is how much? 239. The EMI you're paying is 263.8. The interest for 1 year on the remaining amount is 23.98. And the principal amount you have paid is 239.8. So as a result, when you make the fifth year payment, the remaining principal left is 0. Did you understand the concept? So this is what we call as fully amortizing bond. It means the company is paying a regular payment, which includes some interest component and which includes some principal component in such a way that by the end of the fifth year, the company does not have anything left to be paid to the investors. Now, it can be in the form of EMI payment. EMI means the payments are equal for all the 5 years. Another way of doing it is company will say, okay, in the first year, I'll pay interest of 100 plus I'll pay 200 rupees ka principal. Second year, I'll pay interest plus another 200. Third year, I'll pay interest plus another 200. Fourth year, I'll pay interest another 200. And fifth year, I'll pay interest and another 200. So along with the interest on the remaining amount, I keep paying 200 rupees every year. As the payment keeps going, like as the principal keeps going down, my interest component will keep going down. And on the top of it, I paid 200 rupees in the form of principal. So by the end of the fifth year, I've repaid the full money and there's no major payment which is going at the end of fifth year. But in both the cases, I will call that these bonds are fully amortizing bonds. Fully amortizing bond means that you are repaying the full amount over a period of time with no major amount pending at the end of the maturity. Now, there could be some bonds which are partially amortizing. What is partially amortizing? Every year I'm paying interest plus 100 rupees. Because I'm paying 100 rupees every year, I've already repaid 500 rupees. So the remaining amount left is around another 500 rupees, which I'll pay. So here I'm paying 100, here I'm paying 90, here I'm paying 80, here I'm paying 70, and here I'm paying 60. So what I'm doing every year is I'm repaying the interest amount plus 100 rupees ka principal. If I keep paying 100 rupees principal every year for the next 5 years, at the end of 5th year, only 500 rupees ka principal is remaining. So these kind of bonds are what we call as partially amortizing bond. Means part of the payment you are making on a regular basis and the remaining payment will be done at the time of maturity. So these are the three bonds. Bullet structure, full payment at the time of maturity. Fully amortizing, the full payment will be paid over a period of time, but it could be a mix of both. Some payment over a period of time and some payment at the time of maturity. See, 230.97. In our example, that number was 263. Partially amortizing is a mix of both. There will be some payments on a regular basis, but there'll be some major payment at the time of maturity, that 500 crore rupees, which is what we call as balloon payment. There's a sinking fund provision. Let's say if the bond is a bullet structure bond, it means the company will have to pay 1,000 crore rupees at the time of 5 years. How will the company get 1,000 crore rupees in one single shot? And you cannot take out like 1,000 crore rupees from the business, right, in a one single shot. So what the company does in those cases is they make a sinking fund provision. What is the sinking fund provision? The company will keep putting some money aside on a yearly basis. Let's say they'll keep putting 150 crore rupees aside on a yearly basis. In the next 5 years, what money they have put aside is 750 crore rupees. But they do not just keep this money just like ideal. They invest that money somewhere. So generate return on that 150 crore rupees every year. And you do not invest this money into stock markets. You invest this money in a very, very safe investment. As a result, you try to plan it in such a way that you keep enough money aside yearly, and on that money you generate return, so that by the end of 5 years you'll get 1,000 crore rupees in that particular fund, and you'll take the money out of that fund and pay the money to the investors. So this kind of a provision is what we call as sinking fund provision. So this way the company will not have to take out 1,000 crore rupees from the business in one single shot. They can keep the money aside on a regular basis. Variable interest rate I already talked about. In this case, the coupon rate changes along with the market rate. If the market rate goes up, the coupon rate also goes up. If the market rate goes down, the coupon rate also goes down. So these kind of bonds are mostly trading at par. Why they're trading at par? Because you're always getting what you should get, because the coupon rate is always equal to market rate. There's one trick here, and these are the questions I've seen in the exams, that there could be a time that these bonds may not be trading at par. So the resettlement, let's say the coupon rate is 10%, the market rate is 10%. I told you the market rate changes every minute, every second, every day. Are you going to reset the coupon rate on a every minute basis? No. So there's generally a timeline. Maybe you'll say that, okay, I'm going to reset the coupon rate to make it equal to market rate at the end of every 3 months. So the last reset you did was on 30th of April. But as on 19th of May, the market rate has gone up. Because the market rate has gone up, the coupon rate should also go up. But will it go up now? No, it will go up after 30th June. So for those 2.5 months between today and 30th June, there will be a difference between the market rate and the coupon rate. Let's say the difference is 2%. So you lose 2% for 3 months. So technically you lose 0.5% on that bond. So the bond can be trading at a slight discount. So I've seen a question in the exams that will the floating rate notes always trade at par? The answer is no. Between the resettlement dates, it can trade at a slight discount or a slight premium. But on the resettlement date, they will always trade at par. Now, these are the flavors I was talking about. Some bonds might have some flavor. The flavor could be that the coupon rate is not fixed, the coupon rate is floating. Another flavor could be that these are step-up coupon bonds. I'll give you an example. Let's say I'm starting a particular venture. I'm starting a new business. It's a startup company. I need money. So if Reliance is borrowing money in today's Indian market, the rate of interest you are charging, guys, is around 11%. That's a fact. But let's say there's a company called ABC. What is company ABC? Is a new venture started by us. We go to the market, ask for money. Do you think we'll get money? Maybe not. Even if you get money, will you get money at 11%? No. What do you think you have to pay to borrow money from the market? What's the rate of interest? And we're not Ambanis and Adanis, right? Make a guess, the rate of interest you might have to pay.
Fifteen, 16%.
Yeah, and maybe I'll go to the 18% number. So the problem here is that if we borrow 100 crore rupees, why we are borrowing money? Because we want to invest in the company and we want to grow the company. Is the company making profit in the first couple of years? No. Are you capable of paying 18%, 18 crore rupees in the first year in the form of interest? No. And this is the problem. This is a catch-22 situation, that the startup companies can borrow money at a very high interest rate, and they are the least capable of paying any interest rate in the market in the early years. In the early years. So if the startup company says, hey, I don't have enough money in the first or 2 years, I can pay you only 6%. Do you think as a startup will ever get funding? The investor will say, you get lost, I'll go and give the money to Ambani's and get 11% return. But the problem is that not that I don't want to pay you, but I don't have money in the initial years. So in this case, the kind of structure I can do is, I'll say, okay, dude, I don't have money in the first year, I'll pay you only 6%. In the second year, I'll pay you 10%. I know it's lower than what Ambani will pay you, but don't worry. In the third year, I'll pay you 15%. In the fourth year, I'll pay you 20%. In the fifth year, I'll pay you 30%. If you calculate the average, the total money I've paid you is 16%. But as I grow further, as I grow my business, I'll be more capable of paying you the money. It's just that I cannot pay you the money today. I can pay you more and more money later in the years. In this case, the bond agreement will sound like I'm promising to pay holder of the certificate INR 1,000 rupees as on 19th May 2019, 29, and the interest will be 6% for the first year, 10% for the second year, 15% for the third year, 20% for the fourth year, and 30% for the fifth year. So the coupon rates will keep increasing with every passing year as per the pre-decided agreement. And these kind of bonds are what we call as step-up coupon bond. The coupon rates are increasing every year. But that's not subjective. It's all pre-decided. Now somebody asked me, sir, जैसे step-up coupon bond होता है, do we have a step-down coupon bond? Yes, theoretically you can talk about a step down coupon bond, but I don't see any use case for a step down coupon bond. I've never seen a company which have more ability to pay the money today and will have lesser ability to pay the money 5 years down the line. And if you have more ability to pay the money today, why you're taking the loan itself? So there's only a step up coupon bond. There's nothing called step down coupon bond. There's something called payment in kind bond. Payment in kind bond would mean that the interest what you're receiving this 100 rupees what you're receiving every year, rather than company paying you in cash, the company will give you more bonds in the company itself. So this is what we call as payment in kind. So after 5 years, you'll have bonds worth 1500 rupees. Because you're not getting 100 rupees ka cash, you're just getting bonds or the debentures in the company. So what they will do is in the first year, they'll give you 100 rupees ka bond with a maturity of 4 years. In the second year, they'll give you 100 rupees ka bond with a maturity of 3 years. In the third year, they'll give you a bond of 100 rupees with a maturity of 2 years. In the fourth year, they'll give you 100 rupees ka bond with a maturity of 1 year. So by the end of fifth year, you've got all the bonds maturing and you'll get lump sum money in your hand. We are in the world where everybody is talking about environment.
Can you
So
please
पहले तो
repeat the last point once, Ansh? The payment in kind of bonds.
it's just like the company is not paying the coupon rate in the form of cash, but they're paying the coupon rate in the form of another bond.
Okay.
So again, the companies which does not have enough cash flows for the next few years, they're kind of saying that, see, I'm paying you the money, but it's just that I'm not paying you in the form of cash. Green bonds, these are the bonds where the coupon increases if the company does not meet the environmental goals. The logic here is that, let's say if the company is into an industry where the environment impact is quite significant, there could be a big liability on the company if they do not meet the environmental goals. As a result, the risk associated with the company has increased. As a result, you want to be compensated for that higher risk. So let's say if it's a metals and mining company, oil and gas company, they have a target that they'll keep the carbon emission at 100 units. If the carbon emission is more than 100 units, there's a very big chance that they'll get a big penalty from the regulators. As a result, the company might become less profitable. So to cover that risk, you are saying that, okay, if you meet your target, I'll charge you only 10%. But if you do not meet your target, you'll have to pay me more than 10%. And guys, you would have seen around yourself that there's so many cases where the penalties and the fines could be quite significant if the company does not follow the environmental rules. There are other bonds, which is what we call as interest indexed bond. I told you, right? If inflation in the economy is more, investment into bond is a blunder. I'll give you an example. Let's say the bond is giving you 8% return. Why do you get 8% return? उसमें से inflation itself is 6%. When you get 8% return from a bond, of that 6% is just a compensation for a higher inflation. What do I mean by that? Let's say मुझे एक कार खरीदना है, ठीक है? And the car is going to cost me 20 lakh rupees. But I'm thinking, yaar, ki maybe if I can postpone my consumption of a car by 1 year, and rather than consuming the car today, if I buy the car after 1 year, what will happen? If I consume the car after 1 year, I can keep this money 20 lakh rupees aside and invest in a particular bank. So at the end of first year, the 20 lakh rupees will become 21.6 lakh rupees because I'm getting 8% return. I'm very happy. Wow, I got 1,60,000 rupees in the form of interest. Then I go and buy the same car. Is the same car available for 20 lakh rupees anymore? No. Now the same car is available for 21.2 lakh rupees. If I buy the car today, I pay full 20 lakh rupees. But if I buy the car after 1 year, I'll save 40,000 rupees in my pocket. So net, am I getting 8% return? No, I'm getting only 2% return. And this is what we call as real return. 8 minus 6, which is equal to real return. What am I getting real return for? This real return is for me doing a compromise. What compromise I did? I did not buy my car. I gave the money to the bank, and maybe the bank gave this money to, let's say, Varun, who could buy his own car with my money. I did a big compromise. I let Varun buy the car with my money. Oh, I'm not trusting Varun. I'm trusting the bank. But the compromise I'm doing here is that I'm postponing my consumption. And the second thing is I'm trusting the bank. And we are in a situation, guys, not only the companies are going bankrupt, not the banks are going bankrupt, the countries are going bankrupt. So it's not an easy thing to trust a bank. And how can we forget things like Yes Bank and the many other cases in India itself? You know? So this 2% is my real return. So think about, I invest in a company bond for next 10 years and the coupon rate is equal to 8%. I'm saying, okay, it's a very safe company. If the company is giving me 8% return and assuming the inflation is 6%, 2% ka real return is okay. So this is worth trusting the company and it's worth that I'm postponing my consumption and I'm being paid 2%. After 1 year, inflation goes to 7%. My real return becomes 1%. And after 2 years, thanks to COVID-19, inflation goes to 10%. So you are getting still 8%, but you're not making 8%, you're technically losing 2%. So guys, we say that the fixed income is the worst thing you can have when there's an inflation in the economy. Because when there's an inflation in the economy, the coupon rate you're going to get is fixed and your real return goes negative. If you invest money into real estate, that's fine. Because if there's an inflation, the value of real estate will also go up. If you invest money into equity markets, if there's an inflation, the equity value will also go up. If you invest money into commodities, gold, when inflation is higher, the value of the commodity will go up. But the problem with fixed income is that because your income is fixed, irrespective inflation going up, your returns remain fixed. As a result, your real return falls and sometimes real return becomes negative. So I will say that this is the worst hedge against inflation. So only those people should invest into fixed income who believe that the inflation is going to be lower than estimated or will be equal to estimated. If you think inflation can be higher than estimated, stay away from fixed income. Now, to cover this risk, there are some bonds which will give you inflation adjusted coupon rate. So the issuer will say that, okay, I'm going to give you 8%, assuming that the inflation is 6%. But if inflation turns out to be 7%, I'll pay you 9%. Inflation is 5%, I'll pay you 7%. These kind of bonds are what we call as inflation adjusted bonds or interest indexed bonds. The coupon rate is adjusted for the inflation while the principal value remains unchanged. Okay. Now, इसी का there is a similar bond called capital indexed bond. In case of a capital index bond, if inflation is more than estimated, you do not increase the interest rate, you increase the principal amount. I'll give you an example. Let's say you issue an 8%, you issue 8% coupon rate and the inflation was 6%. If inflation turns out to be 7%, what we'll do is you'll increase the coupon by 1%. Net in both the cases, my real return is equal to 2%. These are interest indexed bonds. But another way I can do it is that when the coupon rate is 8%, the inflation is 6%. If inflation goes up to 7%, in that case, I do not change the coupon rate. I keep the coupon rate to be 8% only. But the value of the bond, 1,000 rupees, I'll increase it by 1%. I'll increase the principal by 1%. So क्या होगा? On this 1010, I'll get 8% return. Technically, I'm getting 80 rupees 8 paisa, but every year I'll keep getting that 1% more. And at the time of maturity, also I'll get 10 rupees. So this is what we call as capital indexed bond. That the interest rate is not being increased, but the principal value is increased by that much amount. So I'll repeat. In case of interest index bond, the interest rate is adjusted up, the coupon rate. But in case of capital index bond, the principal value is increased, but the interest rate remains unchanged. And guys, these capital index bonds are very, very famous. And this is what we call as treasury inflation protected securities, where if the inflation is more than expected, the value of the bond, the coupon rate or the face value or the principal value is increased, but the coupon rate doesn't change. And in short, people call it TIPS. The interest index bonds are less common. The capital index bonds are more common. But in both the cases, you are getting a protection against inflation. Zero coupon bond, I already talked about. There's something called deferred coupon bond. What is a deferred coupon bond? About a startup company, our own venture, which we started. We went to the market to take a loan. Market expects 16% return, but I don't have money in the initial years. So I can say, hey, I cannot pay you any interest in the first year. I cannot pay you anything in the second year. In the third, fourth, and the fifth year, I can pay you 27%. On an average, I'm paying you how much? 16%. But I'm not paying you any interest for the first 2 years. So this is what we call as deferred coupon bonds. That I'm deferring the coupon for the initial years because I don't have money. But then in the later years, I pay you a much higher return so that I can compensate for the interest which I've not paid in the initial years. So read with me. Regular coupon payments do not begin until a specified time after issuance. So maybe in this example, the regular coupon payments will start only from the third year. It's just like in case of a zero coupon bond, you're deferring the payment till the maturity. In case of a deferred coupon bond, you can defer the coupon by 1 year, 2 year. Zero coupon bond is also a deferred coupon payment. It's just like you're deferring the payment after 5 years, which is the maturity of the bond. There could be some contingency provision on the bond. What is contingency provision? That you can add some flavor into it. And these flavors are what we call as embedded options. So I'll get into it. Is a very important concept. I'll do it very slowly. But before that, guys, any doubts, any questions? I'll stop here for a few seconds. Do it like in most of the batches, but I want to understand that how difficult you are finding the course overall, like what we discussed. So on a scale of 1 to 10, if you're finding it very easy, put 1. If you're finding it very, very difficult, put a score of 10. But if you can put a score in the chat window between 1 to 10, 1 being very easy, 10 being very difficult, in terms of today's class, what we are having. So this will help me to slow down or to pick up the pace depending on your feedback. And I want a response from all of you so that I can get a very good idea about the consensus here.
So there's question and answer and polls option. So where do we put it?
Oh, the polls, I cannot decide the question. So just like in the chat window, if you can put. Oh, sorry, Q&A window you can put, sorry.
Okay, cool.
How does it work, guys? Can you see others chat or the others Q&A?
No, I guess.
Okay, so only I can see it, okay. So I'm getting an average of around 3 and 4. The couple of outliers with a 7 and 8. Maybe I don't want to speak the name. If you're fine, can I say the name? Like people who are finding it difficult? Cannot let me say it out. Okay, guys. So mostly I would say that if I take the average of everything, it's close to 4 and 5, which is fair. It's just like I got one person with a score of 8, and I got many people with a score of 3. So the good thing is nobody's finding it very easy. There's no score of 1 and 2 because then it's a waste of time. But at the same time, there's no 9s and 10s. It means you're completely blank. Sorry, I can't resist myself, but given there's no 7 and there's only single 8, Anusha.
Yeah. It's I don't have any background at all, right? So
Okay.
I'm just
So
trying to catch.
Right. Can you explain me a bit more, like what you're finding difficult, like the calculation part or the speed at which we are doing it?
No,
Or
no,
is it
as
like
in
too
like
many new
in the
concepts?
theory, even when I read it in my own time, there's a lot of terms used which are probably very basic, but I don't know the definitions of them because my background is completely tech.
Hmm.
So then it's like I'm googling one definition and then trying to understand what the sentence is saying. Then I understand. So it's taking me very long to kind of go through the syllabus.
Okay, let me help you here. Okay, Anisha, let me go around the room. Anybody with a commerce background, by the way, in this room? Finance background? Lots of people, right? Can I have one person like who has not done the post graduation in finance or commerce, but done the graduation in commerce or finance?
The BBA graduates.
Okay, so in this case, Rishabh, if you remember, did you do all these things in your graduation?
Not really.
Not really, right? So the reason I'm asking this question, even I didn't do it in my graduation. So Anusha, like this is one thing which I've seen many a times that people who do not come from a commerce background or a finance background, they got this misperception or an hesitation. Arey yaar, because I do not come from this commerce background and a finance background, I'll find it difficult. Trust me, CFA, the syllabus, 75% to 80% is what we don't do in our graduation. So it doesn't matter whether you come from a finance background or not. So please get rid of that hesitation that because you do not have that graduation wala background in finance or commerce, you'll find it difficult. Because even if you don't find it difficult, you'll pretend it, your perception will be that it's difficult. That's the reason I'm trying to tell you this. And if you ask me that because you do not come from a commerce background or a finance background, maybe you just spend like 10 to 20 hours more. That's it. That will put you on par with anybody with a finance background.
Okay.
So you need a bit of unlearning in the sense that get rid of that fear.
Okay. All right.
And majority of the people who do this CFA course is people who does not have a commerce background. So if you go to any IMs, the top IMs, 70% of the people doing MBA in finance are the engineers.
Yeah.
Not the BCom graduates. These are not the BBA graduates.
And I am from BA and I did my MBA in finance.
Okay. And have you done these things in your course?
No, mostly these are not there. Few things are there, but most of them are not.
Yeah. And that should give you more comfort, Anushka, that even people in MBA in finance does not get into that depth.
Okay.
They will discuss about fixed income. What is fixed income? Maybe they'll talk about coupon rate and couple of things, what we discussed in the first half an hour. But do they get into these kind of details? No. Oh, by the way, we didn't even get into details. We are still at the tip of the iceberg. The CFA का detail तो will start धीरे धीरे करके अभी, है ना? तो वो जो होता है ना कि fear of unknown या फिर just because you think that you do not have that background, वो baseless fear है, is all I'm trying to communicate here. Anyone, any other question, any other doubts?
Yes, sir. In payment in kind, like you
Mhm.
said, instead of cash, we get the bonds.
Yeah.
So for those bonds as well, do we get interest rate?
Yeah, obviously.
And also, like, what will be the interest rate?
Similar interest rate. Or maybe, see, these kind of details are not there, but ideally you should not get the coupon rate on the original bond. You should get the coupon rate which is in line with the today's market rate. Ideally, but we don't get into those kind of details. It's just like, the payment in kind, you should know the concept.
So, but like, why would anyone choose to go for bond in kind? Because the choice of bonds would not be according to their will.
Yeah, like generally I want cash, but let's say if the company does not have cash, so it'll be a pre-decided agreement. See, nothing can be changed. So when you're buying the initial bond for $1,000, at that point of time itself, the company will say that, hey, the coupon is equal to 10%, but it's not a cash coupon, it's a payment in kind coupon. If you don't want it, don't apply for the bond. Don't take it. But if you take it, you'll have to follow all the terms and conditions. And the reason the company will offer payment in kind, because maybe the company is in a startup or the company doesn't think they'll have enough money in the initial years. So they want to pay the money without paying the money.
So it's almost like taking equity instead of debt.
They are?
It's almost like taking equity instead of debt because at that
No.
time.
They're not giving equity. They're again giving another bond itself.
And I'm just saying that since they're not in the position to pay at that point, like they're
Yeah.
in kind.
Right. Any other question? Any other doubts? Okay, let's talk about embedded options. Let me make this framework here. I just like copied and pasted everything. Right. In case of a plain vanilla bond, of bond without any flavor, if an investor buys this particular bond with 1,000 rupees of face value with a coupon rate of 10%, we say that there are two things. One is primary market and the other thing is secondary market. What is a primary market? The company, as let's say I'm a company, I'm issuing this bond. I'll come to you guys and say, hey, this is the bond worth 1,000 rupees and the coupon rate is 10% with a maturity of 5 years. So on 18th May 2024, I am taking the money from you and I'm giving you the bond. Now, once you buy the bond, you can trade it in the secondary market. It means you can purchase and sell it among yourselves. You can purchase it and sell it to others. But don't come to me. The doors are closed for the next 5 years. Even if you want to sell, I won't purchase it from you. By buying this bond, you trusted me for 5 years. Don't even show me your face. As a result, whatever trading happens between 18th May 2024 till 18th May 2029, that's in the secondary market. It means company cannot buy this and you cannot sell it. So in this case, there are some options. Now, before I talk about options, we'll discuss more about it in derivatives. And we touched upon options in corporate finance class. And we concluded one important thing about options, that options are always good to have. All options are always good. What are the kind of options I'm talking about? We discussed about, let's say you have an option to cancel your flight tickets 1 hour before departure. So let's say I'm going from Bangalore to Delhi. The flight ticket is 5,000 rupees. But if I cancel it, how much refund you get, guys, if you cancel your flight tickets? Anybody has an experience?
Not that much.
Give me some number, like how much you get back.
2,000, 3,000.
Oh, you are lucky one, man. Like if you book it directly from flight like Indigo or SpiceJet, you'll get 2,000 rupees back. The mistake I did once was like the ticket was worth 5,000. I booked it to make my trip. So Indigo charged me 3,500. Make my trip charged me 1,000 rupees. I got 500 rupees refund. But let's say if I give you an option that even if you cancel your flight 1 hour before departure, you'll get 4,800 rupees refund. Are you ready to pay more for the flight tickets? Yes. Why? Because you get an option. So options are always good. So in this case, there could be some options which are embedded in the bond. Embedded means they are just like super laid. They're just like a topping on the bond. What kind of options these are? They can be a callable bond. What is a callable bond? Callable bond means these bonds can be called back. Who can call back the bonds? Can the investor call it back? They already have it. The company can call it back because they issued the bond and they can call it back. And these bonds are called callable bonds. So the company / issuer has an option to call it back. There could be a puttable bond. What are puttable bonds? Who can put it back? The person who is holding it. So the bond holder / investor can give it back to the company. Now, if it's a callable bond, the company has an option to call it back. So let's say I issued the bond and I decide that I want to buy the bonds back. Now, even if you don't want to sell it, you will have to sell it because option is with me. You are just a follower. You have an obligation. You cannot say no to me because when you bought this bond, we agreed that it's a callable bond and it's agreed that company can buy this at 100 rupees at any point of time, or at 1,000 rupees at any point of time. It's all pre-decided. And because you signed on the paper saying that you agree with the callable bond being called by the company at 1,000 rupees at any point of time, if I ask you to sell the bond, you do not have a choice but to sell the bond back to me. Same thing with the puttable bond. let's say the investor has an option to purchase it back, or sorry, to sell it back to the company. The company cannot say no to it, but the company will have to take that piece of paper and give 1,000 rupees back to the investor, irrespective what is the market rate, irrespective what the market value is.
So in case of the callable bond, will they get the interest till what time they have held the bond? Or
Yeah, obviously. So interest part is separate. That too you'll get. The principal part की बात चल रही है.
okay.
वरना तो company क्या करेगी, just like a day before interest, give me the bond back. So interest is separate. That will be paid. If you understood this part, let's do some qualitative high-end work here, okay?
Hello, sir.
Yeah.
So in callable or a puttable bond, only this can applicable if the borrower choose the option of callable, correct?
Yeah. So in this case, when the company is issuing the bond on 18th May 2024, that time the company will decide whether it's a plain vanilla bond or a callable bond or a puttable bond. If there's no mention of callable bond, the company cannot call it back. The company cannot put an option afterwards. Everything has to be done on day zero.
So
it should be part of the indenture.
Yes, sir. Usually when the interest falls, company call the bond. But in such scenario, that borrower will face the losses, correct, sir? So
yeah,
it
you're
will
just like, I'm coming to that. I'll discuss that. Like what you said is absolutely correct. I just want to do it a bit slowly so that others can follow that argument.
Okay, okay, sir.
Okay. So what Rakesh is saying is, let's say the company issued the bond at 10%, the market rate was 10%, the face value was 1,000, and because the coupon rate and the market rate are 10%, the market value is also 1,000 rupees. The company issued the bond on 18th May 2024. Let's say a few days down the line, the company has got some big contracts. The company's margins have improved. The company has become a lot bigger. The industry is doing good. As a result, the market rate has gone down to 9%. If the market rate goes down to 9%, the value of the bond goes up to 1,038.9 rupees. As an investor, you can always go and sell this bond to somebody else at what price? 1,038.9. But the problem here is that, let's say it's a callable bond. It means the company can call it back at any time from you for 1,000 rupees. So let's say Nandini had this particular bond. She comes to me, hey Ansh, do you want to purchase this bond? Given the coupon rate is 10%, given the market rate is 9%, this bond is trading at a premium. I would say, Nandini, this is a good bond. I will get 1% more for the next 5 years, which is 10 rupees extra for every year for the next 5 years. But the problem is that I don't know when the company will buy it back. And what are the chances that the company will buy this back from me? The company has an option to purchase at 1,000 rupees. What is the market value? 1,039 rupees. There's a very high chance the company will say, hey, dude, keep this 1,000 rupees, give me this bond. So these bonds will never trade at such a huge premium. They might trade at 1,005 rupees, 1,010 rupees, but they will not trade at 1,040 rupees because there's always a risk that the company will call the bond back. Let's do it more qualitatively. The company is giving how much interest on this bond? 10%. But the market rate has come down to 9%. It means if a company takes a new loan today, if the company issues new bond in the market today, they can get the same amount of money at 9%. So what they will do is they will take new money at 9% and they'll pay this old money at 10%. So there's always a tendency for the callable bonds to be exercised. What do I mean by exercised? The company using the option to call the bonds back when the market rate is lower than the coupon rate. So when the market rate is lower than the coupon rate, the company will feel like, why are we paying more when the risk perception associated with the bond is a lot lower? Or in other words, the bonds will be trading at a premium. The company has an option to purchase at 1,000 rupees. The company will pay 1,000 rupees to purchase the bond back. As a result, the company will find it profitable to buy the bond back. So these callable bonds are exercised when market rate is lower than the coupon rate. In other words, the market value is more than the face value. So guys, if I give you an option, a plain vanilla bond versus a callable bond, everything is same. The coupon rate is same, the maturity is same, everything is same. Which one will you pay more for? A plain vanilla bond or a callable bond?
Mostly a plain vanilla one.
Yes, because in plain vanilla bond, nobody can come after you. See, the problem here is that the company will be coming after you only when you make profit. Let's say the market rate goes up to 11%. You're stuck. You're getting 10% when you should get 11%. Do you think company will call this bond back? No. Even if company wants to pay the money, they will go to the market and purchase it for 963 rupees. Why will they pay you 1,000 rupees? So callable bonds will be exercised by the company only when it's profitable for the company. And when it's profitable for the company, it's bad for you as an investor. So guys, if you have an option, that's a good thing. But if somebody else has an option, that's the worst thing you have.
So
Yep.
that is that major point bothering me, that if at initial stage we go for particular bond of the XYZ company, so why the particular borrower choose call option if company is already why the particular borrower will choose the call option, sir? And then
Say it again. Say it again,
sorry.
please. Sorry, I got distracted.
Okay. So at initial stage, sir, a particular borrower will purchase the XYZ company bond. So I'm not getting that if the company, if in that particular case, if there is already call option, why the particular borrower choose the call option bond? Because he already known to that if there is a profit, company will withdraw their bond. Correct, sir?
Very good point. So why will you buy a bond which is a callable bond? Because you can never make a profit on that bond. So the logic here is that, and this is the reason I was doing,
yeah. And borrower, and in terms of company perspective, if the client borrower is earning profit, why they will call their bond? That logically I can agree that if someone is earning profit, they will immediately withdraw their bond. But I'm not understanding in borrower perspective, sir. That's the point.
The investor perspective, you're not understanding why the investor will invest.
Yeah, sir. Especially in call option, he already know that if he is in profit ratio, the company will withdraw their bond. So why did he go for that?
Okay, that's a very good point. So
Yes.
in this case, a plain vanilla bond, if there was no call option here, if it was a plain vanilla bond, it will be trading at 1,000 rupees. Why? Because your coupon rate is 10%, your market rate is 10%. If the market rate goes down to 9%, you make profit, and the company can't call it back, so you make profit. If the value market rate goes up, you incur a loss. It's a fair game, so you pay 1,000 rupees if it's a plain vanilla bond, right? But if it's a callable bond, the problem is that if the market rate goes up and you incur a loss, the loss is yours. If the market rate goes down, the profit is not yours. So heads, you lose, tails, you don't win. It's a lose-lose situation. Now the question is, why will somebody buy a callable bond under that circumstances? The answer to that question is, you'll get it at a discount.
Discount in the sense, if we purchase with 1,000 face value, when the company call, if that price was to 875, then they will purchase at 875.
No. So it means that if this particular bond is worth face value of 1,000, coupon rate of 10%, market rate is also 10% currently. The market value is at 1,000 rupees currently. The company has an option to call it back at 1,000 rupees. Technically, this bond should be trading at par. But
Yes, sir. Correct.
given it's a callable bond, it will be available at a discount.
Like, and then in that case, like the investor will get a benefit of price appreciation. If like,
Yes, exactly. So 20 rupees is the short benefit, even if the company buys it tomorrow.
To borrowers.
To the investor.
So can we say that callable bonds are always at discount, sir? Then only there's a benefit.
No, that's a technically wrong thing. There's a possibility that the plain vanilla is at 1,050, so the callable is at 1,020.
Okay.
On a relative basis to plain vanilla, the callable bonds will be at a lower price, keeping everything else constant.
Okay.
And the gap of 30 rupees is the cost you are paying. Sorry, is the compensation you are receiving because company has an option against you.
Yeah. Okay, it makes sense.
And see, this is a finance thing, right? There's no soft feeling. Company will not be, अरे यार, इसका ऋषभ का नुकसान नहीं होना चाहिए. Rishabh should not incur loss. It's a fair world, right? Company will call it back the minute they find it opportunistic and profitable for them. And if it's profitable for the company, it's bad for Rishabh. It's a zero-sum game. यहाँ पे win-win situation नहीं है कुछ भी. There's no mutually good scenario. Okay. Now there could be a puttable bond. What are puttable bonds? As an investor,
I have one small question.
Yeah, please go ahead.
Sorry to interrupt. Like, say, like, in that case, like in the initial interest payment that they were paying, say 10%, will that be continuing, or will that also like stop when the bond?
Obviously.
Right.
Don't be greedy.
No, just
you'll get the interest till that particular day.
Okay, like that particular time.
उसके बाद तो obviously if your payment you receive back, right? So what interest for?
Okay, understand.
But let's say if the interest is due on 31st of December, if company calls it back on 30th of November, so 11 महीने का interest the company will have to pay. No doubt about it. Let's go to puttable bond. In this case, the investor has an option to offload the bond to the company. You can go to the company at any point of time and say, hey, give this bond, give me my 1,000 rupees. Now, this is a very solid thing, right? Because if the market rate goes down, it means the company is paying you 10%, but you deserve only 9%. Will you go back to the company? No, you'll just keep holding the bond. But let's say if the market rate goes to 12%, you'll surrender your bond, get your 1,000 rupees, and invest in a new bond, which is paying you 12% with a similar risk. So this is a win-win situation. In case of loss, you give it back to the company. In case of profit, you keep it. Now, everybody will love to have a puttable bond, right? But there's a cost to it. And the cost here is you pay a higher price compared to a plain vanilla bond.
Yes. The puttable bond might be risky to particular companies, sir.
Absolutely. So if in case of a puttable bond, the option is with the investor, so it's risky for the company. In case of a callable bond, the option is with the company, so it's risky for the investor. So what I'm saying here is, let me put it a different number here. So the difference between the, go ahead.
In puttable bond, is the interest rate vice versa, sir? If increases, then
no. So if this, whatever happens to the market rate,
okay.
Okay. So when will it be exercised? The puttable bond will be exercised when market rate is more than coupon rate.
Yes, sir.
You should get more. but you're getting less, you'll simply give it back to the company. Or in other words, when market value is less than face value, you will sell the bond back to the company. Now, guys, in this case, if it's a plain vanilla bond is worth 1,000 rupees, a puttable bond will be worth 1,018. Why are you paying that 18 rupees extra? Because you are enjoying an option. And this is what we call as value of an, in this case, it's a value of put option. Put option means you have an option to sell. But the problem here is, here you are ready to pay 20 rupees less. Why is 20 rupees less? Because you don't have an option. Somebody else has an option, and that somebody else will use that option against you. As a result, we call it cost of call option. If you had a call option, then there will be a value for it. But because somebody else has it, there's a cost to it. Now, there could be a third category of an embedded option, and we call it a convertible bond. Convertible bonds are the bonds which can be converted into equity. But who decides whether they want to convert into equity or not? It will be decided by the debt holder. So if they think that the share price is going up, they can change their train from the debt to equity. If they think equity is not doing good, they can continue being on the train which is on the debt side and keep getting a fixed rate of interest. So they get the best of both the worlds, and they can change from debt to equity whenever they want it. See if they have covered anything else. So callable bond we discussed, lots of details. I'll get into call protection and call period in a bit. We discussed about puttable bond. We discussed about convertible bond. We'll discuss more about convertible bond, but let me go and double click on callable bonds. In case of a callable bond, there could be something called call protection. What do we mean by call protection? Let's say if the company is issuing a bond for next 5 years. Many times the company will say, okay, I'm issuing the bond for next 5 years, but for the first 2 years, I cannot call it back. I can call it back only from the third year onwards. So at least for the first 2 years, there's a call protection I have. Though it's a callable bond, but it cannot be purchased back in the first 2 years. So that restriction is what we call as call protection. And if it can be callable beyond June 1st, this is what we call as the call period, where the bond can be called by the issuer. Similarly, there can be a put protection. Yeah. Sorry, say it loud, Souvik.
Can you repeat once?
So the call protection, let's say it's a 5-year bond, and the company will say it's a callable bond, but we cannot call it back in the initial 2 years. So the initial 2 years is the period for which you have a protection from the call option. It means the company cannot exercise that option against you for the first 2 years. And as I told you, it's a risk for the bondholder because company has an option in this case against you.
But here the investor knows that for 2 years he's safe.
Yeah, exactly. So there's a call protection of 2 years, but still it's a risk because beyond 2 years, the company can call the bond back. And when will they call the bond back? When the market rate is lower than the coupon rate. You're enjoying that period. Wow, the company is paying me 10%. When the risk associated with the company is only 8%, you're sitting on a Goa beach, enjoying that extra 2%. You'll get an email from the company, hey dude, surrender your bond and take your 1,000 rupees and get lost. Puttable bonds gives the bondholder the right to sell the bond. Okay? Now, I want to discuss more about convertible bond because they have covered some more thing about it. And you have to understand the logic behind convertible bond. You know? A typical convertible bond, let's say a company has a bond as well as an equity in the, either you can buy the company's bond or you can buy the company's equity. Company's bond is available for, let's say, 990 rupees. Okay. And what the bond does, it'll give you 10% return every year. So this is the market value. The face value is 1000. Coupon rate is 10%. And this is a convertible bond. It means it can be converted into 10 shares. Agree? Currently the equity value is 100 rupees. As share का भी face value होता है, equity का भी face value होता है, by the way. Do you know what is the face value of MRF shares? MRF shares are currently trading at 1,25,000 rupees.
It's very small, like 2 rupees or.
To be honest, मुझे भी नहीं पता कि,
Sorry? 10 rupees, I guess.
It's 10.
100 rupees, 1000 rupees. But guys, to be honest, मुझे भी नहीं पता कि क्या है face value, and I don't care about it. In case of debt, I care about face value because this is what I'm going to receive at the time of maturity. But in case of MRF, whether the face value is 2 rupees, 20 rupees, 100 rupees, or 10,000 rupees, how do I care? This will give me an idea that how much the share price have gone up in the last few years. But am I going to get the face value ever? Is completely irrelevant in case of share market, that what is the face value? Nobody asked that question ever. So in this case, let's say this equity is currently trading at a market value of 100. What is the guarantee? How much return will you get on equity every year? How much equity do you get, guys, every year? Is the company guaranteed?
Ding.
Sorry. And I think I got disconnected for a second. Can I request all of you to please switch on your cameras, guys? I see just a couple of you with your cameras on. So in this case, what is the guaranteed return on the share market? How much is the minimum return the company will pay you every year?
12, 15%.
There's no guarantee. हो सकता है particular year the share price will go down and they may not pay you any dividend. So in case of debt, if the company does not pay you the interest as committed, you can drag the company to the court. But in case of shares, in case of equity, if the company does not pay you dividend, if the share price doesn't go up, you can do nothing. So as a result, if you invest money into equity market, generally the company pays you dividend. That's the only surety you have. And can anybody tell me what is the dividend amount you get generally in Indian market? Some companies pay you a huge dividend. Some companies pay you very less dividend. But on an average, a typical Indian company pays how much percent in the form of dividend? Any idea about that? Sorry? Guys, I think some people are trying to speak, but I'm not able to hear. It's very feeble. What's the rate of interest? 1 to 2%. Yeah, I fully agree with that. That the rate of interest in that case is, in case of the dividend amount, in case of Indian market, is around 1 to 2%. Let's keep it 2% for the time being. This kind of a situation is impossible in the market. There's some problem in this entire equation. Can somebody think about it? A bond trading at 990 rupees, which can be converted into 10 shares. The equity is currently trading at 100 rupees. What is the problem in this entire setup? Think logically. You'll get your answer.
Or maybe discretion of a company.
In the sense,
Maybe they're winding up.
winding up the business. Why? How do you get that feeling? Guys, this kind of a setup gives you a clear arbitrage. What is an arbitrage? We are going to have further discussion about it. But for the time being, arbitrage is free money. Have you, like there's a saying, right? There's no free lunch in this world. But it's like a free lunch. Why there's a free lunch? But this is a setup where I can buy a convertible bond for 990 rupees. You know what I'll do? I'll leave my job. I buy like lakhs of bonds by paying 990 rupees per bond. As soon as I get the bond, I'll convert into 10 shares. As soon as I get 10 shares, I'll sell it in the market for 1000 rupees. 100 into 10, 1000 rupees. I'll make a profit of 10 rupees into the number of bonds. I'll keep my profit in the pocket. Again, I'll go buy the bond. As soon as I get the bond, I'll convert into shares. As soon as I get the shares, I'll sell the shares in the market. So technically, if somebody wants to buy the shares in the market, either they can buy the shares directly and pay how much? 100 rupees, or buy convertible bond and convert into equity. What you pay in that case? You pay 990 rupees divided by 10. You pay 99 rupees. Now, guys, don't think, yeah, there's a difference of only 1 rupee. The difference of 1 rupee is a lot when some hedge fund is going to use algo trading to buy and sell millions and billions of shares in this particular stock every minute. They'll become more richer than Mr. Warren Buffett in a single day if this kind of opportunity exists in the market. It's like a free money lying on the road. You collect as much as you can. So let's think about it. This is impossible that this bond will be trading at less than 1000 rupees. Because if it's trading at less than 1000 rupees, it's giving a free money to the investors. They can buy the bond, convert into shares, and then sell the shares. And they can keep repeating the cycle. So there'll be a huge demand for this particular bond because it's available cheap. And there'll be a big increase in supply of shares because everybody wants to sell. So eventually this price will go beyond 1000 rupees. So it's very obvious that a convertible bond, if you convert that into equity, that will cost you more than buying the equity directly. If you buy the equity directly, that's going to cost you 100 rupees. But if you buy the convertible bond and convert into equity, that is going to cost you. Why is going to cost you more? So in this case, think about your objective is to have equity exposure in the company. That's your end objective. You can take two routes. Route one, buy the shares in the company directly. How much will you pay in that case? You'll pay 100 rupees. Take a route two. buy convertible bond, and then convert into equity. And guys, this won't be 1020. Generally, this will be at 1050. So as a result, your average price will be 105. Okay. Now, in this case, I'm saying whether you take a route 1 or a route 2, are you getting to your objective? In route 1, you're buying the shares. Are you getting liquidity exposure? Yes. In route 2, if you buy a convertible bond and then convert into equity, are you getting to your objective to get an equity exposure? Yes. But the route 1 is going to cost you how much? 100 rupees per share. Route 2 is going to cost you how much? 105 rupees per share. Which route will you take? Will you take route 1 or route 2? Obviously, you'll take route 1 because it's cheaper. But wait a minute. Route 2 gives you some benefit. What are those benefits? The route 2, let's say if the share price goes down. The share price goes down from 100, it becomes, let's say, 70 rupees. If you're in route 1, because you bought the shares directly, you lose 30% of your money. But in route 2, you will not go from debt to equity. You will remain at debt. Are you able to follow? So the downside is protected. If the share price goes down, you do not get impacted because you will not convert from debt into equity. But if the share price goes up, here you'll get the benefit. Here also you'll get the benefit because you'll still get 10 shares by giving that particular bond. And those 10 shares will be worth 1400 rupees. So your downside is protected and upside is still available. Nice thing to have. No
So
downside,
can
only
we
upside.
say that there's a premium of 5 rupees here to protect the downside?
That's one part. The second part is if you take route 2, in route 2, you currently have a debt, and the debt gives you 7% return in the form of interest. But if you had a equity, which is route 1, they'll give you 2% dividend. And the difference between this 7% and 2% is equal to 5%. So not only your downside is protected, but your current income, we call it current income. It's not like the profit and loss from the capital gain, but the annual income is higher. Guys, route 2 will always be a premium route because your downside is protected. And the second thing is you are getting an interest income which is higher than the dividend income in the initial years.
Ansh, can you please repeat the second one, the interest payment and dividend?
So generally the coupon rate 7% the minimum coupon rate, right? उतना तो fixed deposit में मिल जाता है, right? आज के दिन. But a typical Indian company pays only 2% in the form of dividend. So if you take route 1, share price को भूल जाओ, you'll get 2% every year. But if you take route 2, you get 7% every year. So getting 5% more if you take route 2. So the logic here is if I take route 2 and hold the bond for 2 years, I got 5% plus 5%, 10% extra. And how much did I pay for that route extra? I paid only 5 rupees extra. It's good to take route 2. I got the upside, I got the extra income. But if I take route 2 and convert from debt to equity within 6 months, it's not worth it. Because I paid a premium of how much? 5 rupees. But I benefited by 5% only for half a year. So it's not worth it. So guys, conversion price, in this case, this is the par amount per share at which the bond may be converted to common stock. In our example, that's equal to 105 rupees. But if you buy the bond and convert into equity, the conversion price is 105. The conversion ratio is 10. The conversion value is 105 into 10, which is equal to 1050. Guys, there will always be a premium because of the thing I discussed. There can never be a discount. The premium you are paying is because one thing, you have an option, your downside is protected, and every year you're getting more interest income than the dividend income. There's something called warrants. We'll discuss about warrants more when we get into equity investment class. But warrants again give you an option to purchase the shares at a particular price. So let's say if I join a particular company, the company management might say, hey, okay, we don't want to pay you a huge amount of salary in the form of cash. We will pay you 10,000 shares. And you can buy these 10,000 shares by paying 300 rupees per share. If the share price becomes 1,000 rupees, you still pay 300 rupees. So when Paytm went for an IPO, lots of these people, employees having a warrant, became like crorepati's overnight. So these people had a salary of 20-25 lakh rupees per year, but their warrants, if they exercise the shares, they pay some money, and the money they'll get from the market, the differential profit was few crore rupees. So because
Something
of
like
that,
ESOPs.
Yeah, ESOPs kind of. Now these are contingent convertible bond. These are convertible bond, but they'll be converted automatically. It won't be based on the discretion of the investor. It won't be based on the convertible bond holder's option, but they'll be converted automatically if something happens. That something could be if the company gets acquired or something, it will be pre-decided. Now the problem here, guys, is that let's say if I take route 2, I would love to be on route 2 forever, right? क्योंकि share price ऊपर जाएगा वो तो I can always take the benefit. The minute I convert, I'll get the benefit of that. The downside is protected, and every year I'm getting 5% extra return. And the company doesn't want it. That you are enjoying the luxury of both the worlds. That your downside is protected, your income is higher, and you're still getting the upside. So in this case, see the anticlimax. Most of the convertible bonds are callable bonds. So the company will say, hey, it's a convertible bond, but it's also callable bond after 2 years. So when company sees that you're not shifted from route 2 to route 1, you're not converted your bond into equity, they'll send you a circular, hey, I'm planning to call the bond back in next 1 month. So what will you do is you'll be forced to convert from debt to equity. So the callable bond part is just like a compulsion for you to move from debt to equity within 2 years. If you don't do that, you have to surrender the bond and give the bond back to the company. Company knows that nobody will surrender the bond. उसके पहले ही वो convert करके equity में चले जाएंगे. But if you do not have the callable provision into this, these people will keep enjoying route 2 forever. The bonds can be domestic or the foreign bonds. Issued by a domestic company is a domestic bond. Issued by a foreign entity is a foreign bond. There could be euro bonds. So let's say if an Indian company, so guys, don't worry about the word euro. It has nothing to do. It's just like an Indian bond issued outside India is a euro bond. The global bonds, bearer bonds, guys, these are like, very, very theory. You can read through it, nothing much. Sukuk bond, these are like Sharia. This became very, very famous in Middle East at some point of time. You can read about it. Taxation of bond income. So guys, I'm like skipping the theories like plain English, and I'm sure you can read through it. There's nothing much. I want to focus on the core fundamental part. So let's go to the next topic, which is about fixed income issuance and trading. So let me stop here. Did you understand the callable and the puttable part? Because we are going to do a lot of work on the callable and puttable part as we go further in fixed income. And did you understand the logic, the convertible bond ka logic, and why the convertible bond has to be a callable bond always, and why the convertible bond will always have a conversion premium if you want to convert that into shares. So shares directly will be worth 100, but if you buy a convertible bond and convert into equity, that should be worth more than 100. Oh, by the way, we're not even started with the topic yet. We're just doing the theory and just like very, very superficial things. We'll go deeper. And level 1 is easy. We'll go much deeper when we get into level 2. So when I said fixed income is difficult, I didn't mean this part. This part though is very easy. It's very simple. When we get into the third and the fourth class, this is when things starts going a bit dark. So guys, enjoy when you can. Let's do some more theory. The bonds can be divided into various types depending on who the issuer is. The issuer can be a sovereign, means the central government. Non-sovereign means it's a government but not a central government. It can be a state government, municipal governments. It can be issued by the company. It can be issued by special purpose entities. It can be divided based on the credit quality. So these bonds are rated by the credit rating agencies. In case of India, I'm sure you'd have heard about CRISIL, ICRA, CARE. These are all India-based domestic credit rating agencies. If you go global, it could be S&P, Moody's, Fitch. These are the companies which give the credit rating to the global bonds. What do? They take a bond and decide whether it's a AAA rated bond, which is like the safest investment in the world, double A, triple B, double B, 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 triple C, double C, C, B. Really, these are the credit ratings given by these organizations. Like it's from the safest to the worst. These are the default. It's like either on the verge of default or is going to default for sure. Now, who will buy these bonds? There are many people who will buy these bonds because in these cases, the face value is 100 and the market value is 10 paisa. By chance, if the company doesn't default, by chance, if the company recovers, by chance, if the company gets some funding, your money will become 1,000 times. So guys, there's always a buyer for everyone, everything. Okay? It's just like the price what you pay. A AAA rated bond is the safest, AA, A, and triple B. These four categories are called investment grade. Investment grade means people like you and me who doesn't understand the fixed income market very well, like an individual investor or a small investor, can invest into these bonds. So this is the reason we call it investment grade. Anything below triple B, this category is, we call it non-investment grade. I don't mean that people should not be investing into it. It's just like a retail investor or a person who's a layman investor should not be investing into it. It's only for the large institutes. It's only for the large players who understand the markets better and who understands the risk they are taking. So these bonds are called non-investment grade, and they are also called as junk bonds. Junk bond means high risk, high return. Generally, the coupon rate here will be 8 to 9% in India's context. Here it will be around 10 to 11%. Here will be 11 to 12%. Here will be like 13. Itna zyada nahi hota. Here it will be 8. Here it will be 9. Here it will be 10. Here it will be like around 12. Here will be 13. Here will be 15. Yahan pe you start getting into high teens, 16, 18, 25, 45, something of that line. तो यहाँ पे coupon rate ज़्यादा नहीं होता है. It's just like your discount is very significant. A stock worth 1,000 rupees will be available for 5 rupees, 7 rupees, 10 rupees. So it can be based on the credit quality. The investment grade is something which is triple A से लेके triple B तक. Triple A, double A, triple B. Bonds which are double B or lower, they are called high yield bonds. It means the yield is higher. If the interest rate is higher, or they are also called a speculative bond or the junk bonds. The bonds can be divided based on the maturity. If it's a less than 1 year, we call it money market. If it's more than 1 year, we call it capital market. So they have divided the bonds based on the credit quality and the maturity. A bond which is less than 1 year ka maturity and which is risk free. This includes only the treasury bills. That's risk free is only the treasury bonds. Treasury means issued by the central government. So if it's less than 1 year, we call it treasury bills. If it's more than 10 years, we call it treasury bonds. If it's 1 to 10 years, we call it treasury notes. But if it's being issued by companies and other organizations, they will be investment grade. Means they're in triple B, A, double A, triple A, but they're not risk free. High yield means they're double B, B, triple C, double C, C, and all of it. So the top layer, top left layer is the safest. Bottom right is the worst. एक तो maturity लंबा है and they're risky as well. The high yield sector also includes the bonds of previously investment grade issuers that have been downgraded by credit rating agency due to deteriorating credit quality. So there could be many bonds which were AAA, AA, or A at some point of time, and you invested the money there. But because the company kept doing bad, the industry is doing bad. As a result, the company's credit rating kept falling down, and today's company's credit rating is triple C. So it's a non-investment grade today, but it used to be an investment grade a few years back. So these kind of companies are what we call as fallen angels. They were angels, but now they've fallen to the ground. They're not flying in the sky anymore. Interesting word, fallen angels. Syndicate facility. This means that, let's say, Mr. Ambani goes to ICICI Bank and say, hey, I need. Himanshali, good to see you back after long. You switched on your camera just now, right? You're on mute.
My camera was on.
It's Zoho, it's not you. Pata nahi. Well, I can just see like 3 or 4 of you, and I don't know. Something is bad. I'm not liking Zoho at all. So currently I can see
change layout.
on the layout. Yeah, I did it, and then it shows me like if I say change layout, it shows me a sidebar.
If you are sharing your screen, then you can't see everyone. You have to just scroll down.
Okay, let me stop sharing the screen for a second. And then still I cannot see everyone.
Then you have to change the layout.
Oh, then change the layout. Okay, change layout. Tiled.
To tiled. Then you can see everyone.
Yeah, I cannot like I can just like see camera like the video for Souvik, Nandani, Himanshali I can see now, and Rishabh.
And in between, the camera goes off automatically in this. I don't know how, but it turns
Yeah,
off automatically.
let's try. Like we can't do much about it. Okay. I trust you, Himanshali. I'm sorry for the false allegation again. So let me share the screen. Okay, so Mr. Ambani goes to ICICI Bank and says, I need 1,000 crore rupees. Or there could be two scenarios that ICICI Bank does not have that much money. And even if they have that much money, they do not want to keep increasing the exposure to a single person. So what ICICI Bank will do is, they will make a syndicate with other banks. They will call HDFC Bank, they'll call SBI Bank, they call Axis Bank, and they will have a meeting together. And ICICI Bank will say, hey, I've got Ambani as a client. I don't want to pay 1,000 crore rupees as a standalone. Can we all four of the banks come together and offer him 1,000 crore rupees? So this is what we call as syndicate facility, that multiple lenders coming together to provide a single loan. But that's only for Mr. Ambani going for 1,000 crore rupees. If I go and take a loan for 30 lakh rupees from a bank, the banks don't have to make a syndicate in that case, right? So a huge amount, a large borrower, this results into syndicate facilities. Cool. So here, guys, maybe we'll do this particular grid and then we'll call it off. So there are different products in the market and there are different takers of these products in the market. For example, I'll tell you, okay, like we go to a particular vegetable and the fruits shop. I find it very discriminatory, but this works for them. So this particular store has got 3 heaps. So let's say mangoes, right? So one is for like people like me, right? Mass. They got a big heap of it, selling it for 100 rupees per kg. Reasonable mangoes, कुछ खराब रहेगा, okay size, and like maybe not washed properly. They're just like lying in a heap. You can purchase it for 100 rupees per kg. Now, where the discrimination starts is that right next to it, they've got a smaller heap. These are the premium mangoes. They look so beautiful, if you just look at them. And they're better. They have no spots on them. Very neat and clean. Oh, wait a minute. Before you get excited, they're worth 150 rupees per kg. I feel jealous that I can't buy it, but I just feel that I could buy this. And then I feel bad. There's another heap with like a rotten mangoes. I mean, like they will be smelling and like, and they're just kept aside, like almost outside the shop. I was wondering, like and there's a tag. They are available for 20 rupees per kg. And what? Like there are people who will still buy those. There are people like who cannot afford 100 rupees wala and they'll buy that 20 rupees per kg. So what I'm trying to say, guys, is that there's a buyer for 150 rupees per kg. There's a buyer for 100 rupees per kg. There's a buyer for 20 rupees per kg, depending on what's your income level. Similarly, depending on the risk of the bond, there's a buyer for that particular bond. Who will be the buyer for the default risk-free bond, where the risk is 0? The people who will be investing into it are the banks who want to park their short-term investments. Let's say, they have got some extra money at the end of the day. They want to park that extra money for some time. They cannot take risk. They'll park that money in the default risk-free bonds. But there are some people who want to take some risk, like the pension funds, the insurance companies. Now you'll be like, "Arey yaar, how come the insurance company or the pension fund can take risk?" How many of you are salaried, by the way, here? Anybody who is getting a salary? Okay, Souvik, congratulations. Your pension money, the provident fund money, is being invested by the company in a investment grade or a high yield bonds. If these bonds default, you may not have a pension at the time of your retirement. How do you feel about it? So it's bad, right? That how can the pension fund invest the money into investment grade? And what about your insurance? Let's say if I've taken my life insurance, I've taken my car insurance. If I die, though I paid premium every year, but when I die and my family people go to the insurance company, they say, "Oh, you know what? We invested the money in the bonds, but these bonds have defaulted. Sorry, we don't have money." So it sounds very counterintuitive that how the hell the insurance companies and the pension funds are allowed to invest money into investment grade. They should be investing money only into default risk-free, right? But guys, pension funds and the insurance companies can take more risk. And the reason they can take more risk is because they do not invest for 1 year or 3 years. They invest money for 20 years. हो सकता है 1 साल में loss होगा, but in the long term, you'll make more money. We'll discuss more about it when we get into portfolio management. But if your time horizon is longer, like you're a young investor, you can take more risk. Because even if the market falls, you can wait for the markets to recover. But let's say if I'm 55, I'm not 55, guys, I'm much younger. But let's say if I'm 55 and I'm going to retire at 60, what if the markets decline for the next few years? Can I wait for me until I die for the markets to recover? Maybe I can't. So if your investment horizon is longer, you can take more risk. So it sounds very counterintuitive that the pension funds and the insurance companies should not be investing into investment grade, but they still invest into investment grade, especially the insurance companies. Pension funds still invest into default risk free, but the insurance companies are allowed to invest into investment grade. It depends on the insurance company you are. Let's say if you're a life insurance company, what is the expectation, guys? You pay a premium. How often are you going to claim money? I've been paying my life insurance premium for the last 17 years now. Thankfully, I've never claimed the money yet because I'm still alive. Oh, by the way, I also have a car insurance. And I'm a very bad driver. And every 2 years, I go to the insurance company asking for a claim. So what I'm trying to say here is that if you're an auto insurance company, if you're a health insurance company, you're a car insurance company, the premium you're going to get, you'll have to pay to the customer every now and then. You cannot park that money for a long-term investment. But in case of a life insurance, the premium I'm paying, okay, I may be unlucky that I'll be claiming that premium today in next half an hour, but most probably I won't be getting that premium. I don't want that claim, right, for the next few years. So the company knows that only 1% or 2% people will be taking the claim in the next few years. They can take this money and park it in the long-term investment. So the life insurance companies can invest money into the investment grade, but they can invest the money for a long period of time. Okay? Hedge funds, they are notorious to take lots of risk. I work in a hedge fund. I don't agree to it to a great extent. We take a calculated risk. We're not like stuntmen, like who just take the risk for the sake of it. But we do not get carried away by the market reaction. So lots of hedge fund became very, very attractive during COVID-19 because when the individual investors or the small investors were getting anxious where the markets were moving, hedge funds have a proper policy in place. They were making a huge return without losing their calm. There are people who invest into distressed funds. उनका कोरी वो होता है कि अच्छा this company looks distressed but this company can recover. It cannot recover back to 1,000 rupees, but even if 0.1 becomes 2 rupees, their money becomes 20 times and they're more than happy to get out of it. There's a concept called dead cat bounce. Have you heard it? Dead cat bounce. If a cat falls from the height, first of all, they are like so, unka aerodynamics aisa hota, they always land on their feet. But still there's a possibility that they can die. But before they die, they jump once and before they die. This is what the science says. I don't know. So these fallen angels, if they're falling from the height, they come down to the ground, but before they really die, they bounce once. So if I want to make a chart out of it, how do you do that? Is there a way I can draw something?
You can show yes bank, sir.
Oh, yes, bank, but it's not dead yet, right? It has recovered. So, you know, it's falling, but it bounces once and then it falls, and then it's over. So even if you get a dead cat bounce, so you bought it here and there's a dead cat bounce, you get money multiple times and you get out of it. So this is what the distressed debt fund, they get the expertise into, that which funds are close to bankruptcy, but they may not go bankrupt. Or even if they will go bankrupt, there will be a dead cat bounce. Okay, so let's continue in the next class on different types of fixed income indices. What is fixed income index and all of it. We discussed about primary market, but we'll discuss more about it. There's a secondary market into it. So like we'll spend another 10 to 15 minutes on this topic before we go to the next topic. Before you run away, just give me a few more, 1 or 2 minutes more. So in terms of broader things, we discussed 49, 50, 51. We're almost on the verge of completing 51. This 52, 53, these are again theoretical. Once we get into 54, fixed income bond valuation, this is where the fun will start, which should be from the third class or the end of second class. 55, 56, things will get darker. 57, 58, 59, things will get better to some extent, but they are very, very complicated readings. So guys, we've got a lot to cover. There are like total, oh my God, 67. There are like 18 readings. We are just done with 3 readings. Sorry, 67. And we started with what, 49. There are 19 readings. We're done with the first 3. I was very nice to you guys today, in the sense that I was very slow, very calm, very patient, doing it slowly, repeating things. Now, because we have got the good foundation, I'll take some liberties going forward and move a bit faster. I always do the first session very, very slow so that you get used to my teaching style, you get used to the basic concepts, and you get your foundation strong. So you may see a big change when we meet next in terms of the speed. So please make sure you study what we have done today and you pre-read what you're going to do. So with that, we'll stop here. I'll roll out the feedback form. Please do fill the feedback form before you log off. And I'm here for you if there's any questions or any doubts you have with respect to what we have done today, what we have done in the previous classes, or anything to do with your CFA.
And one small question, not regarding fixed income, like regarding linear regression. So I was seeing like there were few like topics on the hypothesis testing on linear regression. So do those questions also come, or like do you need to cover those also? Or?
Okay, so yeah, this is the thing. Like, did I cover that in the class? The answer is no. I'll be very blunt about it. The reason being that we should study for 500 hours for CFA level 1, but the classroom is for what? 120, 130 hours. Can we complete everything in the classroom? We can't. But the only thing is, my objective here is to complete like majority of it, especially the important ones. If you ask me like whether it can come in the exam, yes or no, yes, it can come in the exam. But the chances of it coming in the exam is much lesser compared to the other ones.
Okay.
So, but don't leave anything. Just do at least basics of it. Yeah, but do the basics of it. Because I've seen that if the topic is easy, they ask you difficult question in exams. If the topic is difficult, they ask you easy questions on the difficult topic in the exams. So don't get too much worried when the topic is difficult. The questions are generally easier. Yeah, but be worried when the topic is easy. The questions can be very, very complicated.
Okay.
So,
guys, please do fill the feedback form before you log off. Yep.
Sir, I just worried about ethics part, sir, where it is covering the 50 to 20% weightage of overall subjects. So
Yep.
how to go through that, sir?
Okay, so the first thing is good to be worried about ethics. I like it when people get worried about ethics. The problem is that people take it casually.
Yes, sir. Because reading and remembering all those points that bothering me, sir. So how to crack that one?
Okay, to crack that one, read ethics to start your syllabus with. Read ethics somewhere in the between of your syllabus, in between your preparation. Read ethics towards the end of it. Revise ethics. Keep revising it. And see, in case of ethics, like the content is very small. So you have to do lots of questions. Do questions from Swayzer book. Do questions from your curriculum books. Do questions from everywhere.
Okay. Ansh, can you please share the like Swayzer book for ethics and quant if you don't?
I have it, but there could be some markings done. So please ignore that.
No
I can
issues
dump
with the
it right.
marking. We can.
Okay. Yeah, no
Also,
problem.
do we have a WhatsApp group for this batch?
Yes.
Since I joined late, so could you please add or share the link?
Like if you can share the books on the WhatsApp group, that will be really helpful.
I'm not there on the WhatsApp group, but let me just add it right here. I'll add all the 5 books, but there could be some markings done. So
no issues with the markings. We can ignore them.
So I'll add like all the 5 books here in the chat box. I hope they allow me to do that.
So do you have
Does it-
any question banks related this topic?
Let me share everything I have. So I've got this Swayzer books. I've got the curriculum books ka soft copy just in case anybody needs it. Should I dump that as well?
Like dump everything.
Yeah, that's logical.
So the problem here is like not the data. There's lots of information. Like, do you have time to go through it? That's the problem these days.
Yes, no, like
So
we.
the first 5 are the Swayzer books,
Hmm.
and then you'll get a set of 9 books, which is from the curriculum.
How do we access what you sent?
It's there in the chat window.
It is not showing.
Sir, it's not
No.
showing, sir.
Not showing. Are you sure?
Yes,
Yes.
that's not.
Okay, then I don't know how to do it. I dumped
Maybe
everything.
one of us can share email and we
That
can
also
then,
is fine. Yeah, that's doable.
and then that person can share all the material in the WhatsApp group. That
Can someone
I can
add
do
me to the group?
So one of you
Yeah,
give me
please
your
add
email
me
ID.
to the group as well.
I can share my email with you.
Sure.
I will share the material in the WhatsApp. Have you received the email?
Yeah, I got it. So I'm going to send it to Sovic. Putting all the 5 Swayzer books. And the heading I'm putting is Swayzer books. That's one email, which is being sent to Sovic. And another one is CFA books. Will be sent as a Google Drive because it's more than 25 MB.
Okay, no issues. I will share the link then directly in the.
Yeah, it's downloading.
Can someone send the link to the WhatsApp group?
Yeah, somebody please send the WhatsApp group a link in the Q&A window so that others can join or not part of it already.
Like I think it will be done. Like if we share in Q&A group, I think only Ansh can see it.
Yeah.
Oh, is it? Oh my God.
Yes,
Okay.
sir, yes.
Set. Okay. I don't know how to make changes, guys. Sorry. Let me try. So there's nothing I can put which can be seen by everyone. There's no provision for that.
I don't know. Like
To Google it.
I have to do a crash course on Zoho, guys. Maybe. Okay. I've sent you both, Sovic. You can put that in the chat window.
Could you like take down our phone number or something? And add us to
Sorry?
I'm saying, could you take down our phone numbers and add us to the group?
Yeah, actually. And I'll give my number.
I can't add anyone. I can drop a text and in the group and ask them to add. But like I am not the like owner of the admin of the group.
Okay.
It's a group made by the Edupestine people only. So I think you have to ask the representative that contacted you, and they will add you in the group.
Or just, can you just take our numbers and put it on the group so that they add it?
Sure. Just tell me your numbers.
Give my number. 807
807
2626
2626
931.
931. Can you please tell your name?
Yeah, mine is
07 26.
9460.
Okay.
Rishabh, right?
No,
Yeah, Rishabh.
9560.
Just 1 minute. Let us see. Tell me.
Wait, do I say?
Yes, yes.
Oh, 9560 152 117.
Name, please.
Persia. It's written.
Hello.
Okay, guys, so you can coordinate on this. I'll get going. Okay.
Okay. Yes, sir. Thank you.
Thank you, guys.
I have saved your number. Ash. I
Okay,
will.
thank you, Savik.
Thank you, Savik.
Or just share it to us personally if they don't add us to the group.
Sure, I will.
Can you
Yeah.
take my number?
Sure.
Hello.
Thank you, Savik.
Tell me.
990
990
18
18
25
25
12
12
8.
8.
Yeah, 990 18 25 128. Rakesh.
Yeah.
Yeah.
Take mine as well.
Just give me 1 minute. Tell me.
8810
8810. Yes. Next.
39
39
009.
009. Name, please. Name.
Himanshi. Yes.
Himanshi, right? It's 9 digit. Can you please repeat the number once?
88
1
10
0
39
39
2009.
3920. Okay. I will share the. I will ask them to. I will ask them to add you guys on the group, in the group, and I will share the files in the group.
Okay. Okay, thank you, Savik.
Thank you.
Bye.
Bye.
Can you tell your number?